My special guest today is Lisa Forrest with Live Oak Bank. Lisa is one of the best SBA and conventional lenders out there for business acquisition loans. She's been on many times because they always change the rules. And this is the Getting the Deal Done podcast. I'm John Martinka, and welcome, Lisa.
Thanks for having me, John. Really appreciate it. And
Hey.
with some of the SBA SOP updates that have been kind of numerous, I've had the pleasure of talking with you on your podcast quite a bit in the last couple of years.
Yeah, you sure have. So we're going to do it a little differently today. Fun game for the listeners, myth or fact. And everything I'm going to ask you or just make a statement about refer to SBA 7A loans, not real estate loans, unless we mention real estate as part of the loan. So these are a- business loans, business acquisition, franchises, etc. So, first one, myth or fact, SBA acquisition loans have historically been in the black.
That is true. They have historically operated in the black, except for most recently in 2024. The 7A program had losses for the first time in many, many years. So it was in the red last year. There were some fees, SBA fees that had been curtailed, and those are now back, just to make sure that all of the guarantee fees that are paid by the borrowers are definitely there to cover all of the costs of the guarantees. So
Okay.
we assume going forward, we'll be back in the black.
All right. All seller notes have a standby period when there's an SBA loan.
Not true.
Not true. Good. The SBA reviews all SBA guaranteed loans before you make the loan.
Okay, yeah, that was the clarification. Not exactly. There's a process where if you are a preferred lender, there is a process for you to have the SBA loan number issued, but it's more of a checklist, kind of checkbox checklist. The SBA isn't really reviewing your loan. If you are a less than preferred lender, then you're literally submitting the loan to the SBA, and that does get reviewed. But if you're a preferred lender, which is the vast majority of participants in the SBA program are preferred, so the SBA isn't actually reviewing the loan. Now, the bank's credit committee is,
Yeah.
but not necessarily the bank on each and every loan.
Okay. Rates are lower on an SBA loan when the borrower has more collateral.
That is potentially true.
Okay.
And it depends if it's a full real estate loan for an existing owner that's buying the real estate. That's probably the lowest interest rate you get. If you're doing a business acquisition with some amount of real estate, it sort of depends on the amount of collateral there, but you can probably have a sliding scale on interest rate when you have that more real estate collateral involved.
Okay. Uh, a bank using the SBA loan program can charge any interest rate they want.
No, false. If you have a variable rate loan, you can charge up to 2 3/4. If you have a fixed rate, you can actually charge more than that, but there are limitations set by the SBA.
So 2 3/4 over prime.
Over prime, if
Yeah.
you've got a variable rate loan, correct.
Okay. All 7A loans have a 10-year amortization.
No, false. Business acquisition has 10 years, but SBA loans are for real estate, equipment, working capital, startup. So you have varying terms depending on the use of proceeds. But for business acquisition, it is a 10-year term,
Okay.
including all of the assets that you're acquiring.
Great. If real estate is combined with a business acquisition and the real estate is greater than 50% of the total value, the loan will be for the full real estate 25-year amortization.
It's actually 51%. So if
Okay,
it's
greater than 50%.
51%,
Oh, it has to be 51.
mm-hmm,
Okay.
yep,
And then they
yep,
get the
total project.
full real estate amortization.
Correct.
Otherwise, it's blended.
Yep, proportionally 10 years to the business acquisition, proportionally 25 years
Yes.
to the real estate, if it is less than 51% allocated toward the real estate.
10% is the minimum buyer equity on an acquisition loan.
No, it's actually 5% for the borrower, for the buyer. And this is kind of a nuanced question. A minimum
Yes.
10%,
It's a
yes.
trick question.
Yeah, it's a trick question, but 5% really has to be from the buyer. The other 5% can be made up in the form of a seller standby that's on standby for the full 10-year life of the loan. The SBA does want 10% down. 5% minimum has to come from the borrower, cash. You can't get by with less than 5% from the buyer. The other 5% can come in the form of a standby seller note, 10 years on that full principal and interest standby to equal the minimum 10% that's required.
Okay. There are prepayment penalties on 7A loans.
There can be. So let me get into that. So if you've got a real estate loan, if you've got a term of 15 years or longer, if you've got real estate or equipment 15 years or longer, it's a 5%, 3%, 1% prepayment penalty on the outstanding balance. If you've got any term less than 15 years, you need to give your lender 20 days notice if you're prepaying more than 20% of the outstanding loan balance, or you'll have a short interest penalty.
Okay.
But for all intents and purposes, if your term is less than 15 years, there really is no prepayment penalty.
Yeah.
You just
So a
have to
business
give.
acquisition, pure business acquisition loan has no prepayment penalty.
No, just as long as you give your lender 20 days notice if you're
Yeah.
prepaying more than 20%.
Okay. A seller can take rollover equity with an asset sale structure and an SBA loan.
No.
Okay. A seller can take rollover equity with a stock sale structure on an
Yes.
SBA. Okay.
Yes. With some
Okay.
nuances, but I think you're going to get into some nuances on
If, yes,
both.
if there's rollover equity in a stock sale, the seller must personally guarantee the buyer's bank loan
Yes. For 2 years. For
for
two
two
years.
years.
For two
Okay.
years, yeah. And it's
Even
really what it
1%
means.
or any percent.
Any percent. If
Okay.
you've got with a nuance, another nuance to that too, which I'll get into. If you've got your seller, you're buying into their company with a stock sale, and they're retaining ownership. With this change that just came out, any ownership retained 2-year personal guarantee does not include taking their personal assets. So the seller's real estate wouldn't be fair game, but they're going to personally guarantee your loan for 2 years.
So,
And in order to have that personal guarantee rescinded, the buyer, the new owner, has to have 24 full months of uninterrupted payment. So they
okay.
have to be paying on their loan for 2 full years consecutively, months, in order for that PG to be rescinded. There is a nuance, and I hope I'm not going to actually say something and have it turn out to be a myth, but this is the one caveat. One caveat that we're understanding is that if, say, you have an owner, 5% owner, that's maybe the GM, they own 5%. Post-close, if they're going to keep their 5% ownership, they're not getting any benefit of the sale. Their ownership isn't going up, and they're not getting any of those loan proceeds sale proceeds. It's our understanding that like 5% or 10% owner can stay on without having to put a personal guarantee on. So I hope I just didn't say something and have it turn out to be a myth, but that's our current understanding.
What you are saying is it is sometimes hard to understand the SBA government ease language. And this is what you came to a conclusion as of this recording.
Yeah, for sure.
Okay.
And then
Yeah.
sometimes too, these changes come out, and then as they become living, breathing kind of entities, and the process actually starts getting underway, sometimes there are then further updates like, oh, we didn't intend that, or no, we did intend that. So
Yeah.
hopefully we're giving enough time here to know that these are myth versus fact.
Great. Okay. Here's what I think is a big one. An outside investor owning under 20% doesn't have to personally guarantee the buyer's loan.
Correct. That is correct. With some nuances. Do we have time for nuance?
Oh, yeah. Because that's
Okay.
a big one. Because there
Yeah.
is a rumor out there that they do have to guarantee you, yeah, no matter how much they invest.
Correct. And I think that there was a little bit of a combination of this, the seller, staying on and having to PG. And I will say in that one, if I can backtrack for just a second. So if you're doing a partial buy-in and the seller is going to stay on with a PG, any owner in a retained kind of rollover situation has to be a co-borrower, by the way. So you have investors in your cap table, say they're 5% owner. Everyone in a retained equity situation has to be a co-borrower. So you've got a 5% owner that's an investor coming in with you. They don't have to put a PG in, but they are a co-borrower. So for all intents and purposes, you got to check this with your attorney, but for all intents and purposes, all of the same sort of gotchas will apply as co-borrowers. Um, but
Okay.
to
Okay,
answer your
that's really good. But what if there's no seller rollover? So Uncle Bob says, okay, I'll put in 10% for you.
So if you've got 100% buyout and then you've got minority investors in your cap table, that is still allowed. However, there are some nuances, and
Of
that
course.
is, and especially, and this is, I work for Live Oak Bank. I head up our self-funded search vertical at Live Oak. And so this is one lender's opinion as to how we make sure we're on what we think is the correct side of how SBA interprets having minority investors in the cap table. We also look at economic benefit. So what we'll do is we'll look at the preferred returns, if there are those, in fact, preferred returns. We'll look at that and infer that out over a 10-year life of your SBA loan. And if your step up and your basis step up and your preferred returns that you're getting over a 10-year period, in a sense, kick you above really at 20% ownership on an economic benefit, we would then say, well, your investors really actually have benefit of the SBA loan at more than a 20% opportunity of ownership. So we would require that investor personally guarantee your loan as well. So we have a whole equity worksheet that we have you do.
Okay.
If you've got investors that just have common ownership and are less than 20% individually, then that would never come into play and there would
Okay.
be no personal guarantee required there.
So Uncle Bob wants 10% of his nephew's company. He's willing to put in that X dollars, no personal guarantee.
Correct.
Okay. So it's complicated.
It is a little complicated, and SBA with this last update did come out with some very specific rules around investors. You can't have guaranteed distributions. You can still make a distribution in an SBA loan, but if you have equity investors, you can't have a guaranteed distribution. You can't have your operating agreement extend control to your minority investors. So you've got to be reviewing operating agreements. You can't have puts or calls. You can't have automatic repayment on that equity, or it's considered debt. It's not equity. And SBA is absolutely um, monitoring to make sure that equity is really equity and it's not debt.
Okay. Okay. That really helps. Side question. Is that going to affect the market where there are these groups who get investors, package them for a buyer who doesn't have enough money, etc.?
It could. It could very well have some kind of impact. I just know how, one lender, one banker's been doing this, and we've been doing it very, very carefully. But the other aspect to this, interestingly enough, as kind of a segue, is that SBA is now asking when we go in for our preferred numbers to be issued, or your SBA loan number to be issued, SBA wants us to document 100% of the ownership now. So 100% of your owners is now being documented and being input into the system. So I think SBA, and this is not myth or fact, this is just sort of us chatting here now.
Yeah.
So sidebar, SBA is definitely looking at ownership and making sure that the small business buyer, the guarantor, the operator really has control over that company. So this is getting real complicated as maybe more in institutional investors have been bringing sort
Yeah.
of different strategies into the SBA lexicon.
Right. Good. Very, very helpful. Uh, the buyer must make a personal guarantee on the loan.
Again, anyone who owns 20% or
Yeah.
more has to personally
Right.
guarantee. And again, we go as far to say anyone with a 20% or more greater economic benefit would have to
Yeah.
personally guarantee.
The buyer must pledge home equity. They
Um,
have home equity.
if they have it, yes, they have to pledge it unless they have less than 25% value in that real estate. Then the SBA technically says they don't have to pledge it. if they have less than 25% equity value in the home. However, lenders could still require personal real estate to be pledged kind of on any given deal, depending on the nuances with those deals. They still might want the personal real estate to be pledged. Now, if you don't have real estate, but the lender likes everything else about the transaction, lack of collateral is not a reason to necessarily decline the deal per se. That's kind of what the SBA guarantee
Yes.
is there to mitigate.
Okay. Uh, so in the worst case scenario, the loan goes bad and they put up their house, will most banks foreclose?
Very possibly. Yeah,
Probably.
probably. I want to say probably. There are those cases where sometimes homes aren't um, foreclosed on. There could be strategies as to substituting collateral or other things in servicing. But to answer your question, I mean, most probably, if you're putting up your home, there is a real possibility that if things go sideways, that the bank will foreclose on that collateral. Correct.
All right. Uh, the buyer can use a HELOC for their down payment.
They can. I have more nuance for you, John. I know you probably wanted this to be a rapid round that got done in 10 minutes, but there is nuance around the HELOC. You can use it, but the SBA has now reinstated the rule that if you use your HELOC, then you have to have outside income to repay that HELOC. It can't be from your salary from the thing we are financing. So you have to have
Okay.
outside interest, dividend, military veteran benefits, spousal income to cover that payment.
Okay. Uh, an SBA loan can have an earnout.
No.
An SBA loan can have a clawback.
Yes.
And
So it
what
can
they
have a
define a
forgivable.
clawback as is, to my understanding, tell me if this is myth or fact. Uh, if you can say, I will pay you $5 million for your business, but if we don't hit these numbers in the next 2 years, it could go down to as low as 4 million, as long as it meets that coverage ratio at 5 million from day one.
So let me clarify. So if the clawback metric is based on performance that the company has already achieved, yes, you can have that clawback. If the metric is based on the company doing 30% more in the next 2 years, that would be considered an earnout, and that's not eligible. But the
Okay.
clawback can be based on performance that the company has already achieved. Like given that it's middle of 2025, you could base your clawback based on 2024 EBITDA or revenue.
Okay. In that case, it wouldn't work if the company said we have a new product that's just hitting market and that
Correct.
that and we expect it to increase sales. That wouldn't work for a clawback. It has to be
Correct.
a clawback based on continue business to continue as it has been.
Correct. At least as good as.
Based
So,
as, yes.
mhm. Right.
Okay. Uh, Underwriting an SBA loan is the same from bank to bank.
No,
Okay, that's a myth.
absolutely not.
All franchises automatically are eligible for SBA financing.
No.
New franchises.
Yeah, no. SBA has reinstated the franchise registry. And so franchisors now need to interact with the SBA to get their franchise agreements approved and put on the SBA registry. If it's not on the registry, then it's not an approved franchise for SBA lending. They're double checking elements of control and making sure that the franchisees are really independent operators.
Okay. So we talked before about SBA loans in the black. Have SBA loans for new franchises been in the black
You know
traditionally?
what? That is a good question, John. I think you're asking me for a specific reason, but I don't have an answer to that. I'm
Okay.
assuming that that's probably a myth, but
I read it goes back in pre-COVID. I did read that the SBA would be even more profitable if they didn't lend to new franchises.
oh,
But that was like
got it.
7 years ago.
Yeah. New
Okay.
franchises are tough. I mean, even for us, we have a franchise vertical at Live Oak, and we're lending, from a kind of vertical perspective to like the more seasoned concepts.
Okay. Uh, a bank can ask for more than 10% down from the buyer.
Correct?
Okay.
Absolutely. It's going to be all based on debt service coverage, et cetera. And I'm going to
Yeah.
say a big chunk of our loans, given where the multiples are in the market right now, from the sell side, at least half of our deals have a requirement of more than 10% down just to make the deal
Yeah. And
pencil.
too many buyers are out there going, I'm going to put 10% down. And oh, I want this $5 million business, and I'm only going to put in, 500,000 plus my percentage of the fees and or line of credit, et cetera. And but my debt coverage is so tight, I can't do it. Well, maybe you should be putting in more.
Correct.
Yeah. Okay. Uh, a bank can offer interest only for a set period at the start of the loan.
They can. They can. We are going to look for things like seasonality. If there is a little bit of seasonality and you're acquiring the company and maybe you're kind of your trough, we could do interest only for a period of time. But keep in mind, you still have a 10-year term. So it's
Yeah.
not like you're going to get 10 years plus 6 months.
No.
After your interest only period, we're going to analyze your term on 9.5 years. So you might get a little freedom in that first 6 months, but then your monthly payment is going to be a little bit more tacked on than it would be if you just got a straight 10-year
Yeah.
amortization. So keep that in mind.
So here's a related question. There can be variable payments on the loan to cover seasonality.
There can. Um, we haven't done that very often because if you literally need to do that, then you have big ebbs and flows in seasonality or cyclicality. So a lot of times you might not actually get the loan past your credit analysis if you've got those kind of big ebbs and flows in seasonality or cyclicality, but technically you can do that.
Okay. The SBA gives the banks a minimum debt coverage ratio they must have.
So for business acquisition, it is 1.15 minimum debt service coverage for business acquisition.
Boy, if you don't grow the business, you're going to be in trouble at 1.15.
Yeah, so most lenders out there, that's really more of like a real estate coverage, and
Yeah.
that's for an existing borrower that owns their business buying real estate, you can go that low as well. But so for business acquisition, and if you've ever listened to my, John and I talk over the years, business acquisition is not for the faint of heart, and you need to make sure you have enough debt service coverage to get you through transition and
Yeah.
allow you to have
Which
growth.
you and I have talked. We both agree it needs to be, at least a 1.5 or darn close to it. And if it's a small deal, like if you're financing a $1 million deal, it probably needs to be 2 to 1 because they need that cushion to grow the business.
And just get through transition. Transition is it's bumpy.
It can be, yeah. Uh, okay, so here's one, and I'm going to word, I'm going to say it, but it's a little bit political. But Biden era regulators eased underwriting requirements.
So I don't know if it was so much the president as it was the
The
previous
administration.
SBA administration,
Yeah.
yes. But yeah, in 2022, um, rules got relaxed on down payment, seller notes on your very, very short standbys, counting as your equity, um, no personal resource limitations whatsoever. And the one rule that I really liked though that I wish we had been able to keep was on the seller retaining equity and not having to personally guarantee. I thought that that was a really, really good rule. But yeah, they much of those changes to have been rescinded. And that's why we're doing this factor myth.
That's right. Because yes, I've read about that. With the new administration and the new SBA director, they're saying, hey, some of these things just don't make sense. That's why you lost money.
Yeah, for
Yeah.
sure. And the
Um,
fees that went away that are now kind of reinstated as well too.
right.
It's going to have a big
And
impact on
so
that.
let's clarify. So those for a while there was almost no SBA fees if the loan was under about $1 million, right?
Correct.
And
No
that's
SBA
back.
guarantee fee at all,
Yeah.
under 1 million. And I do
Okay.
think that, the smaller loans can be you know, the harder to transition can be the underperformers on the smaller loans just because you're working with less EBITDA, right? So I think also you had a double whammy too, where some of the rules got relaxed, more small loans got made, and then the fees on those small loans got rescinded. And so I think
Yeah.
that was a little bit of a storm there.
Yeah. Okay. You can have too high a net worth to get an SBA loan.
Yes, you can. You can have too much liquidity now. That rule is back. And the rule is, and hopefully I've got this right, the rule is for loans over $1 million, you can have one time the financing package or $3 million in post down payment liquidity or $3 million in post-close liquidity, whatever higher. And so that's total financing package. That would be a combination of the SBA loan and the seller note. That's your total financing package. You can have one times personal liquidity or $3 million, whichever is higher. And that's after you consider your down payment. There are some exclusions for instance, I'm talking with a client right now. He's in his late 40s. He has two kids about ready to go off to college, and he has college funds, liquidity set aside for college. There are some exclusions that you can include in that to say, hey, these are earmarked for, real personal living need situations.
Okay. So, but in simple terms, if I'm buying a business and I'm getting an SBA loan for $5 million on a six, 7 mil, or let's make it $4 million on a loan on a $5 million business, and I have $6 million in other liquidity, I can't get the loan.
Yeah, because you have more than one
More than,
times liquidity, um, or $3 million at the most, right? So the idea is that you could inject those additional liquidity into it and get a smaller loan. If you have if you have that liquidity earmarked for things like college, or you've got healthcare costs or
yeah.
something. Um, and so the SBA's mission is to provide financing for those that can't otherwise get it. So if you have that much liquidity, hey, you might qualify for a conventional loan, or you might be able to put your stocks and bonds up for collateral and get like, a wealth management type loan or something. So the
Okay.
goal is to have it just those people that can only qualify for SBA have access to those
Okay.
funds.
And SBA loan can be used with the ROPS program.
It can.
Okay.
Yes.
It's a good one. The SBA issues a new SOP once a year.
They don't. It just feels like they have. But I mean, I can remember decades where we had the one SOP and it was good to go for a really, for years and years and years. We've just had, well, with, COVID and the economy and stimulus and, the SBA program does try to keep up with the times, but doesn't always come out every year.
Okay. And what there was a couple years ago, they came out like 3 or 4 times.
Yeah.
Yeah.
Hmm.
Okay. Okay, let's talk about conventional loans.
Sure.
Do they tend to have the same term as the SBA loans?
Not even close.
Okay.
Not even close. So I'll just do a quick compare and contrast.
Yep.
So one of the benefits of the SBA, you get a 10-year business acquisition here. You get a 10-year term. More term drives more affordability so that you're able to get in with less down payment. The SBA guarantees your lender's loan, so it compels the lender to make a loan that is under collateralized or not based on collateral, more so on cash flow.
Yep.
Um, the conventional program is a really highly equitized type of transaction. And typically the term is going to be 5 years versus 10, maybe 7 years, but 5 years. So you're able to afford a lot less debt because of the term. And these are driven by a lot more equity. So where an SBA loan, let's say, is 10% down, 10 seller note, 80% financing, a conventional loan is sometimes, 40% equity, a lot more kind of seller roll or seller note, and the bank may be doing 40 or 50% financing on a much shorter term. And those can have a tendency to be non-personally guaranteed, though. But when you're bringing in that much equity, they have also a tendency to be bigger EBITDA deals and maybe more sort of private equity based or kind of more institutional sponsor behind a conventional type deal.
Yeah, an individual that thinks, well, I'll get a conventional loan, I won't have to make a personal guarantee, is going to make a personal guarantee
Yeah.
on a conventional loan. Yeah, your professional buyers are not. So,
Right, correct. And
yeah,
they
I
also have a lot, not just the down payment or the equity into the deal, they have usually that dry powder or a lot more
yeah.
equity behind them for growth and kind of for those hiccups too.
Yeah, so finish up a little plug for you. You do. a lot of SBA loans. You also do junior debt on top of that if the deal is large enough and it meets requirements. Am I right?
Yeah, correct. We do our max 5 million of SBA plus a pari passu. So we'll go up to say 2.5 million of live oak conventional debt, kind of side by side with that SBA maximum. And to John's point, we are looking for generally, kind of stronger borrowers bringing in more of their own equity there. And if we can get a lot more sort of industry experience or very, very complementary in uh, industry kind of blue collar to blue collar or white collar to white collar kind of experience has a tendency to play better in larger transactions. And if we've got those kinds of things, we'll actually do some conventional debt on top.
And that conventional debt would also would well, I should say would also it would not have the same 10%, would it?
Well, we are going to look at the project all in.
Overall.
So we're going to
Yeah.
look at it all in. So it really is, even though we're doing an SBA plus a conventional, we're doing the analysis all in. So we are looking at, and typically on a larger EBITDA deal driving kind of a bigger purchase price, typically you're not coming in with just 10% down. You're probably coming in with 15, 20, even 25, or maybe even 30% down to sort of make the whole deal pencil. But we're looking at it really all as one analysis,
Yeah,
even though
and
we tranche it into.
I worded the question poorly. Yes, you look at the whole thing, and it will take more money. And I think
Yeah,
but one of the things is, just people buying a business, especially the individual or a couple individuals, should not focus on I'm going to put in as little as I can. They should focus to me on what can I put in to make my debt coverage manageable, especially the first year.
absolutely. And especially on those larger EBITDA transactions, we're typically finding buyers that are really in it to grow the company. So you also want enough breathing room to organically grow your company too. And that's just going to take more equity.
Yeah. Well, Lisa, we buzzed through about 30 myth or fact questions, and most of them led to some great explanations because, of course, when you deal with a government-backed lending program, nothing is as clear as could be. So, thanks for it. Thanks for all the insights, and especially for pointing out that there's still ambiguity in the new rules, and it's your opinion. And yes, another bank may have a different opinion, uh, but that's just the way they wrote them.
Yeah, definitely. And we need a little bit of time to kind of wear this one a little bit longer since it
Yeah.
just came out June 1st. So
Okay. Well, thank
thanks.
you. Always a pleasure to have you on.
You too. Thanks, John.
Okay.
Thanks for having
Bye.
me.
I gotta stop.